Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, I might be getting a little bit ahead of myself, but when I give these webinars, I kind of like to give a little bit of a peek inside of, the way I think about options, having been in the business since 1993, and how I teach my students, of course, about, how to gain an edge in trading. And so, I just kind of want to throw that out there. And, if you're new, it might not make a whole lot of sense, but, that's kind of how it works. Implied volatility is that volatility component of an option's price, and it relates directly. It's stated in the apples-to-apples comparison of historical volatility, the annualized standard deviation. But while historical volatility looks backwards in time at the actual price changes, implied volatility looks forward in time at what the market expects the future price changes to be. Okay, so that being said, let's look at the SFC here, the Swiss franc. With SFC trading at 105.81, the 106 calls, which we'll call the at-the-money calls, are at 101 bid at 111. Now, their implied volatility is 1044. Now, that's stated in a percent, but typically when you talk to traders, they don't say 10.44%. They just say, 10.44. The reason it's stated in a percent, it's the annualized standard deviation in percentage of the price of the Swiss franc. So anyway, really what you use that for is a benchmark. It's basically the relative price of the options. When that implied volatility rises, the price of the options get worth more. And when that implied volatility falls, the price of the options get worth less. Now, Dave has a question. It says, in other words, the market maker knows a scared man pays more. Well, yes and no. I mean, think about your insurance company, okay? If there's two people, driver A and driver B, and driver A doesn't have any tickets, never had one in his life, and drives a Honda Accord, and driver B is 16 years old and has 27 tickets and drives a red Camaro. Which one of these two drivers is going to pay more for the insurance? Well, driver B is, of course. Now, does that mean that the insurance company looks at him as a sucker? No. The insurance company knows that there's a good, they have a better chance of losing a whole lot more with driver B. And it's the same thing with the market makers. If you're buying options, you're buying them from the market maker, and so the market maker is selling options. Now, let's go back to something we just learned. When you sell options, what do you get? You get negative gamma, don't you? Now, market makers trade delta neutral, and they trade big. Negative gamma is a hugely important thing to market makers. When I was a market maker, I can remember days when, if a stock would move down by $5, I'd lose like $100,000 or something if I was negative gamma. Big deal. It's a very big deal. So it's not necessarily that they're just, the market maker just says, oh yeah, these guys are scared, I'm going to jack up my prices. Market makers are saying, I'm scared, I don't want to sell them anymore. I got all this negative gamma. They got to pay me more if I'm going to take on more risk. So that's really how it works. So okay, let's get back to our example here. So with the SFC at 105.81, the 106 calls at 101, or our 101 bid at 111, and that's all predicated around a 1044 volatility. As I just mentioned a minute ago, Vega measures the rate of change of an option price relative to a change in volatility. Okay, so if the implied volatility is 1044, and the implied volatility rises, how much is our option price going to change by? It's going to change by the amount of our Vega. Now, you know, even though Greeks can be used almost the same way in terms of stocks, futures, currencies, the implied volatility you're looking at here, 1044, you know, that's probably around typical for a currency, but it'd be pretty low for a stock. When I give presentations like this talking about Vega changes for a stock, I'll say, yeah, if Vega changes by 1 point or 5 points or 10 points, you know, you make or lose this. You know, if implied volatility changed by 1, 5, or 10 points. Here, you're likely to see a change of a half a point, maybe 1 point. Let's use 1 full point as a benchmark here. If implied volatility were to rise from 1044 to 1144, the price of our option increases by our Vega. Now, just like theta, our Vega is stated in terms of dollars and cents. This is 11 cents right here, 11.04 cents, really. So if the implied volatility rises from 1044 to 1144, we're going to go from 101 bid to 112 bid. We're going to go from 111 offer to 122 offer. Now, if we see a smaller move that, you know, is arguably probably going to be a little more common, say implied volatility rises just half a point to 1094. Well, then we'd see our options rise by, you know, half a Vega or 5.5 cents. So the bid would be like 106 or 107 or something. The offer would be like, you know, 116 or 117. Now, implied volatility can fall too. It's a moving target. It goes up, it goes down. If implied volatility falls, options get worth less. They get worth less by the amount of the Vega. If it fell from 1044 to 944, the new price of our option would be 90-cent bid at $1.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.